Good morning. One announcement before we get started, just a reminder, your second exam is next Wednesday. Posted on the board, I have the room assignments for the exam. They are the same room assignments as you had for the first exam. So just go wherever you went for the first exam. Again, if you're registered through the online business department, make sure you check the information that they sent you to know when and where your exam is. Again, all of the off-campus testing sites test at a different time than on campus. So keep that in mind. Are there any questions about the exam? Again, I will be posting a practice exam probably today. Just like I recommended for the first exam, I recommend you save that till the very end. So get to a point in your studying where you think you've studied everything, you're ready to take the exam, and then take the practice exam under exam conditions. Give yourself 2 hours, take it from start to finish, and then go back and check your answers. Okay. We are going to pick up where we left off on Tuesday, and I've kind of recreated what was on the board at the end of last class. So we're going to briefly go over that before we get into the interest expense section. So just a reminder, here is the entries that you recorded on your bond issue, whether you issued at a discount or a premium. So when you issued at a discount, the cash that you received was less than the amount of the bond. So you debited cash, you debited discount on bonds payable, and you credited bonds payable for that maturity value. Again, remember, at any time you can determine what the carrying value of the bond is. The carrying value is another way of saying the outstanding liability for the bond. In the case of a discount, that's that maturity value, okay, minus any unamortized discount. So minus the amount of discount that's currently on the books. For a premium, when you issue a bond at a premium, you debit cash for the amount that you receive. The amount of cash that you receive is more than the amount of the maturity value, so you credit bonds payable for the maturity value, credit premium on bonds payable. Okay, then in the last class we looked at the cash flows both for discounts and premiums between what your bond or what the company's bond was paying and what a bond at the market rate of interest was paying. And this is what's really going to be important when we go through this section today. So last class we looked at this bond. We had a $100,000 9% 5-year bond where interest was paid semi-annually. Okay, here the market rate of interest is 10%. So we know this bond is issued at a discount. This company's bond pays 9% interest a year. The market, similarly, risk bonds pay 10%. So this is what the cash flows for this company's bond looks like. Okay, the company's going to get the issue price. We figured out the issue price last class was $96,149. Okay, in exchange, the company's going to pay the bondholder $4,500 of interest each interest period and the $100,000 at maturity. Okay, if we look at a market bond, so a bond that pays the market rate of interest, the issue price would be $100,000. And that market bond would pay $5,000 interest each interest period plus $100,000 at maturity. So when we looked at this, we said that the total discount here was $3,851. And we said this total discount, this $3,851 less that the company accepted at time zero, relates to the fact that they pay out $500 less of interest each interest period. Okay? And we said that when we were looking at interest expense, we need a way to be able to record a correct amount of interest expense. What is the company actually incurring? Okay, we said we don't want the company to just be able to record interest expense at the amount that they're actually paying, because that's not really the amount, the expense that they incurred. Okay, they incurred more than $4,500 of interest expense. Why? Because the market rate, the market bond, pays $5,000 interest. Okay, what did they have to do in order to pay less interest each period? Well, they had to accept a discount on this bond. They accepted $3,851 less at time zero on their bond in exchange for paying $500 less in interest each period. So the amount of the expense should be closer to $5,000 than $4,500. Okay, again, we have to figure out a way to take this $3,851 of discount, that amount that they took less at the beginning, and allocate it to each period. Okay, so it's going to increase the amount of interest expense. Okay, same idea in the case of the premium. So here are the cash flows in the case of a premium. So here we have the same bond. The company bond is the same. It pays 9% interest. But now we're looking at a situation where the market rate of interest is 8%. So here the company's bond was issued at a discount, okay, or sorry, a premium. They're issued at 104,100. So the total premium here at time zero that the company received was 4,100. Okay, in exchange, they pay $4,500 of interest each period, whereas the market bond only pays $4,000 of interest each period. Okay, so they have to pay, the company has to pay more interest, $500 more of interest each period. Okay, in return, they got $4,100 more at time zero. So again, our interest expense shouldn't be this $4,500, okay, because that's not what the company's really incurring each year. That wasn't the cost of borrowing that money. The cost of borrowing the money is the market rate of interest. Okay, in exchange for giving $500 more of interest each period, the company got $4,100 more at the beginning, at the issue date of this bond. So again, we have to come up with a way to take this $4,100, allocate it over each interest period, and therefore decrease the amount of interest expense that we're going to record each period. Okay, here are the entries that we're going to record on each interest period. Okay, for our discount, we debit interest expense. Okay, that should be clear that we're going to debit interest expense because this is an expense. We debit it. Okay, that decreases our retained earnings. Okay, we're going to credit cash because we're paying cash on our interest period, on our interest dates. And then we know we're going to credit discount on bonds payable. Okay, how do we know that? Well, again, we can go back to this entry that we recorded at issue. Okay, where when we created this discount, we debited discount on bonds payable. We know our discount has a debit balance. Okay, it's a contra liability account. It reduces our liability. So then when we're amortizing this discount, when we need to get rid of this discount, we need to credit discount on bonds payable. In the case of a bond issued at a premium, our interest payments, we debit interest expense. Okay, we credit cash, okay, because cash is decreasing. Now we have to debit premium on bonds payable. Again, we go back to the entry where we initially issued this bond at a premium. Okay, and there when we had this premium account, when we created it, we credited the premium on bonds payable. Remember, premium on bonds payable is a companion account. Directly related to the liability, increases the outstanding liability. Okay, so our premium on bonds payable has a credit balance. Therefore, in order to amortize it or get rid of it, we need to debit premium on bonds payable. Okay, then our entry at maturity, notice how for our discount and our premium, the entry on maturity is the same. Debit bonds payable, okay, credit cash. We debit bonds payable because we're getting rid of the liability. Once we pay the maturity value, okay, the bond term ends. We no longer owe any money. We credit cash because we're paying the cash. Why don't we need to have a discount or premium in that entry? Because it's gone, right? At the end of your bond term, after you've recorded all your interest, again, why do we have this discount or premium? We have the discount or premium because The amount of interest that we're paying is different than what the market would dictate, what the market bond would pay. Okay, so we're allocating this discount or premium over each interest period, over each interest payment date. Once all the interest payment dates have ended, we should have allocated the entire discount or premium. Okay, we should have amortized the entire discount or premium, and the account should have a zero balance. So on the maturity date, your discount or premium account has a zero balance. You don't need to take it off the books. Okay, any questions? Hopefully that was just a review. Okay, now we're going to look at how we measure interest expense. And we alluded to this a little bit in the last class. There's two methods that we're going to discuss in order to determine what is the amount of interest expense that we record. Okay, we have the effective interest method and the straight line method. So we start off with the effective interest method. And the key to these methods is notice what's in our interest entry. There's three items always in our interest entry, right? We have interest expense, we have cash, and we have the discount or the premium. Okay? Every time we have an interest payment, we always need three things. Okay? Interest expense, cash, discount, or premium. Okay? These two methods that we're going to talk about, okay, each method is going to tell you two things that you compute. And what do you know about if you have numbers for two of three things in a journal entry? You can find the other. The other is a plug number, because remember, debits have to equal credits, right? So if you know two of these numbers, you can calculate what the third is by just figuring out whether you need debit or credit and how much. Okay, so for the effective interest method tells us we're going to calculate the amount of interest expense and the amount of the interest payment. Interest payment you can also think of as the cash paid for interest. So let's start with that, the cash paid for interest. We've seen this before. We needed to calculate this when we were looking at calculating the issue price of a bond, when we were looking at the present value of the maturity payment plus the present value of the interest payments. Okay, in order to calculate the present value of the interest payments, we first had to calculate what those interest payments were, right? So what were our interest payments? Our interest payments was that face value or the maturity value multiplied by the stated rate of interest. The interest payment is what your bond is actually paying. So maturity value times the stated rate of interest. Again, this is stated rate of interest per period. That means if it's semi-annual interest, you'd have to multiply by half or divide that yearly rate in half. Okay, then your interest expense is the carrying value of your bond times the market rate of interest. Again, if it's semi-annual interest, you need to divide the market rate in half. Okay, remember what your carrying value is. Okay, in the case of a discount, your carrying value is your maturity value minus any unamortized discount. So in other words, whatever amount of discount you have left. In the case of a premium, your carrying value is your maturity value plus any unamortized premium. And remember, carrying value is the outstanding liability of the bond. So in the case of day one, when you first issue the bond, let's say this bond that was issued at a discount, what is the carrying value? The $96,149. Times 0, you haven't amortized any of that discount yet, so your carrying value is that $100,000 maturity value minus your unamortized discount, which is the whole discount of $3,851. In the case of a premium, at time 0, your carrying value would be that $100,000 maturity value plus your unamortized premium. Okay, time 0, you haven't amortized any of that premium, so the premium's $4,100, So your carrying value is $104,100. Okay, any questions? Okay, the key to understanding this is two things. First, knowing under this method, under effective interest, the two things that you compute is interest expense and the cash paid for interest. And two, understanding how this journal entry works. Okay, because once you calculate interest expense and cash, okay, discount or premium becomes your plug number. Any questions? Okay, let's go through an example. So this is again the bond that we've been looking at. Okay, $100,000 face value, 9% stated interest, semi-annual interest, market rate 10%. The issue price was $96,149. Okay, how do we record our entries? Take some of this off. Okay, so effective interest method, we compute interest expense and the cash paid for interest. So interest expense equals the carrying value times the market rate of interest. Okay, for our first interest period, what is the carrying value of the bond? The $96,149. Okay, carrying value for the first interest payment is just the issue price because it's that maturity value of $100,000 minus the unamortized discount. We haven't amortized any of the discount yet. Okay, we multiply that by the market rate of interest per period. Here, market rate of interest is 10% per year, so 5% per period. So when we calculate this, we get interest expense of $4,807. Next thing that we calculate is the interest payment. Again, the interest payment is that maturity value multiplied by the stated rate. The maturity value of $100,000, stated rate of interest per period 4.5%. Again, that comes from, this is a 9% bond, but interest is paid semi-annually, so 4.5% per period. So the interest payment, $4,500. So what we calculated back here, we knew that this bond paid $4,500 of interest each period. Okay, once you calculate those two amounts, your discount on bonds payable becomes your plug number. Then all you have to know is how this journal entry is structured. So debit interest expense, credit cash, credit discount. So you just fill these in. So interest expense, $4,807, cash, $4,500. Which means the discount on bonds payable is $307. Any questions? So that's the first interest payment. First interest payment is somewhat easier just because you know that the carrying value for the first interest payment is the same as the issue price. Okay, what happens if we're looking at second interest payment? Well, what do you have to do? First, you have to calculate what the carrying value of the bond is after that first interest payment. Well, the first interest payment, you amortize $307 of the discount. So what is the new carrying value? The carrying value is your maturity value minus any unamortized discount. So your maturity value, $100,000. Okay, you started with a discount of $3,851. Right. Okay, you amortize in the first interest period $307 of that discount. So the amount that you have left as unamortized is $3,544. Okay, subtract that from the $100,000. You get a current carrying value of $96,456. A lot of people will say, well, couldn't you just take this issue price of $96,149 and add the amount of discount that you amortize? You could do that, and it just depends how you look at it. Okay, so now the carrying value is $96,456. So we put this into our equation. So again, we're still multiplying by the 5% market rate. Notice how all these, the issue price that we're looking at, these interest entries are all related to the market interest rate on the date of issue. We never change this. Hey, that original discount was based on that market rate of interest when the bond was issued, so that's what we need to record everything as. Yes, market rate changes all the time. It's going to affect how that bond is traded in the secondary market, but just like stock traded between investors doesn't affect the company, same thing with bonds. Bonds traded between investors doesn't affect the company. So when we do our calculations, we get that the interest expense is $4,823. Okay, what about our interest payment? Well, notice how everything in this equation stays the same. Maturity value, $100,000. Stated rate, still 4.5%. So our interest payment, still $4,500. Which makes sense because we said these were equal periodic payments, right? When we looked at these cash flows, they were $4,500. Okay, so now if we look at our journal entry, we calculated our interest expense of $4,823. Cash still $4,500. And our discount amortization then is $323. Okay, you notice in your slide, okay, we don't have a credit to cash, we have a credit to interest payable. Why? This just goes back to the dates. These bonds were issued on January 1, 2010. Semi-annual interest would mean interest is paid on July 1 and January 1. Okay, remember, assuming this is a calendar year company, their end of the year is December 31st, so we're going to have to accrue for that interest at the end of the year. They're actually going to pay it on January 1st. So on January 1st, it would simply be, interest payable, $4,500, credit cash, $4,500. Debit interest payable, credit cash, $4,500. Okay, but you need to get that interest expense recorded in the correct year. So you accrue for it at the end of the year. That is the difference. Okay, any questions on how we calculated that? Why did the amount of interest expense increase from the first interest period to the second interest period? See, interest expense went from $4,807 to $4,823. Because the carrying value increased. Remember, carrying value is your outstanding liability. Just like any other note or any amount of money that is borrowed, okay, your interest is based on what your outstanding liability is. Okay, so that's why it increased. Since your carrying value increased, your interest expense increased. Okay, here you can see what is referred to as an amortization table. Okay, basically this table just goes through each interest period and lists out what the cash paid is, what the interest expense is, what the discount amortization is, and therefore what the discount balance is. You will probably see this within My Accounting Lab. You will see in the homework where it will have you create an entire amortization table. So if this is a 5-year bond that pays interest semi-annually, there will be 10 columns for you to input all this information and basically do the calculations for each of the 10 interest payment dates. I get a lot of students at this point that do a lot of My Accounting Lab problems that go through these amortization tables, and they think, oh, well, when I get to the exam, I see a problem on this, I'm just going to do the whole amortization table and then I can answer any question. That's great that you can do the whole amortization table, but you will not have time for it. The reason why we do it in My Accounting Lab is so you get a lot of practice. Okay, but just for the exam, just answer the question that is asked. Okay, you can go back and look at this and recreate this and make sure you can do this on your own. Okay, so notice what happens to the carrying value of the bond when you have a bond issued at a discount. Okay, as you go through the bond term, as you near maturity, the carrying value of the bond is going to increase. Okay, it's going to increase, again, till you've completely amortized your discount. Okay, and then what is your carrying value? Once you've amortized your entire discount, your carrying value is just your maturity value, right? Because carrying value is maturity value minus any unamortized discount. The end of the bond term, you will have amortized your entire discount, so carrying value is just your maturity value. So carrying value is going to increase to maturity, at which time the carrying value is just your maturity value. Any questions on discount under effective interest method? Okay, we can do the same thing for the bond issued at a premium. Okay, so again, this was this bond. Okay, same bond, stated rate 9%, but now the market rate of interest is 8%. So this bond was issued at $104,100. Okay, so we have our amortization table. Let's go through the first and the second interest payment. Okay, so first interest expense. What is the carrying value of this bond for the first interest payment date? $104,100. Okay, remember what the carrying value of a bond is in the case of a premium. The maturity value plus any unamortized premium. So for the first interest period, maturity value is $100,000. We haven't amortized any of the premium yet. So the unamortized premium is $4,100. So carrying value $104,100. Multiply that by the market rate of interest. Here again, semi-annual interest. Market rate is 8% per year, so 4% per period. And we get interest expense of $4,164. Here, interest payment, again, maturity value times stated rate. Maturity value still $100,000, stated rate 4.5%. So this bond, just like the last one, pays $4,500 of interest. The only difference is now we're looking at the bond issued at a premium. So when we have a premium, we need to debit the premium to amortize the premium. So our interest expense is $4,164. Cash $4,500. So we figure in our plug number, which is the premium, the difference between the $4,500 and the $4,164, we get $336. Notice how in the case of a premium, the amortization of that premium decreased the amount of interest expense that we recorded. Okay, which when we look at these cash flows, that's what we expect, right? Because this company's bond paid $4,500 of interest each period. The market bond only paid $4,000 of interest. Okay, so we need to get this closer to $4,000. Why is it higher than $4,000? Well, again, it's higher than $4,000 because the carrying value at time zero is 104,100. Our outstanding liability, the amount that we owe, is more. We owe more because we owe $500 more on each of these interest payment dates and then the same $100,000 maturity value. Okay, what about our second interest payment date? Well, in order to calculate the second interest payment date, we have to figure out what the carrying value is. Okay, so again, carrying value, that maturity value, $100,000 plus any unamortized premium. We started with a $4,100 of premium. First interest payment date, we amortized $336 of that. So what we have left is $3,764. So we add that to the maturity value of $100,000. We get a carrying value of $103,764. Okay, so now our interest expense is that carrying value of $103,764 multiplied by that 4% market value. We get interest expense of $4,151. Interest payment is going to remain the same because our maturity value is still $100,000. Stated rate still 4.5%. So our interest payment is still $4,500. Okay, now we put this information in. So interest expense $4,151, which means our premium amortization is $349. Okay, notice how interest expense in the case of a premium decreases each period since the carrying value of the bond decreases each period. So your outstanding liability has decreased, so your interest expense decreases. Any questions? No? Okay, so let's look at the chart of the carrying value in the case of a premium. So we said in a case of a discount, the carrying value increases until it reaches the maturity value. In the case of a premium, okay, your carrying value decreases until it reaches maturity value on the maturity date. As you amortize that premium, okay, the unamortized premium becomes less, so the amount that you add to the maturity value to get the carrying value becomes less, up to the point of the maturity date when there is no premium anymore, and therefore the carrying value is just that maturity value. Okay, any questions? Okay, keep in mind, what do you have to do if I ask you a question on what is interest expense for the second interest period? You have to calculate all the information for the first period in order to know what is the amount of discount or premium calculation, how much discount or premium is amortized in order to figure out what the carrying value is prior to the second interest payment date. Okay, it should kind of remind you of that double declining balance. Okay, if I asked you what depreciation expense was in year 2, under double declining balance, you have to calculate depreciation expense in year 1 in order to know what the total accumulated depreciation is in year 2. Same idea here. Okay, in order to calculate interest expense in period 2, you first have to calculate interest in period 1 in order to get the discount or premium amortization. Any questions? Okay, so our next method, straight line. Okay, there's good and bad news with the straight line method. Want the good news first? Good news first. Good news first is well, I guess really two. It's easier, right? And once you do it for one interest payment date, it is the same for all interest payment dates. Okay, why? Because the two things that you calculate is the discount or premium amortization and the interest payment. Okay, as its name implies, straight line says you take the total discount or premium and allocate it equally, amortize equally over the number of interest payments. So in this situation, $4,100 premium, okay, 10 interest period dates, you simply take the $4,100, divide by 10, okay, and that's how much premium is amortized each period. Okay, since it's an equal amount, same each period. Interest payment is the same each period because the maturity value stays the same and the stated rate of interest stays the same. Okay, under straight line, the two things that you calculate is the cash paid for interest and the discount or premium amortization. Your interest expense becomes your plug number. But because cash paid for interest stays the same each period, discount or premium amortization under straight line, since you're amortizing an equal amount each period, stays the same. Therefore, your interest expense stays the same each period. So once you do it once, you don't have to do it again. Okay? It's the same entry each period. That's the good news. The bad news is that GAAP only allows you to use the straight line method if the difference between straight line and effective interest is immaterial. So basically, if it's almost the same as effective interest, you can use it. If not, effective interest is GAAP. Okay, because again, effective interest is more closely saying this is the amount of interest expense that you should record, because it's basing interest expense on the outstanding liability of that bond. Okay, so let's go through this quickly for each one of these. So the bond issued at a discount. Okay, what would we do? Well, again, the two things we calculate under effective interest is the discount amortization and an interest payment. So the discount amortization equals the total discount divided by the number of interest periods or interest payments. So the total discount here was $3,851. There's 10 interest payments. So the discount amortization each period is $385. Okay, cash paid for interest, that's the same equation. So maturity value, $100,000 times the stated rate of interest, 4.5%. So if we look now at our entry, cash $4,500, discount amortization $385, which means our interest expense is $4,885. Okay, once you do those calculations, that is the same every single period. Okay, so you see in your amortization table, okay, same every period. Okay, if we look at the case of the premium that we've been looking at, Again, we just change this to premium amortization. We take our total premium divided by the number of interest periods. So that 4,100 divided by 10, we get that our premium amortization is $410 each period. Okay, and if we look at our entry, put that in for the premium cash, still $4,500, which means our interest expense is $4,090. Any questions? See, I told you in class on Tuesday, kind of the whole explanation of the interest expense is much more complicated and kind of more to understand than just the pure calculations under the two different methods, under effective interest and straight line amortization. Okay, any questions? Yes?
For the exam, do we have a choice which method we use?
The question was, on the exam, do you have a choice of which method you use? The problem will tell you what method you have to use for any particular question.
But if we forget one method, can we do the other method and answer close to it?
No. The question was, if we forget one method, can we do the other method and get the right answer? No. Because it's two different calculations. It could be two different amounts. There might be an answer choice there that would be under the other method. You need to know both methods for the exam. Any other questions? Okay, so now we're going to make it a little bit more complicated, not much. But companies don't always issue bonds on January 1. Okay, let's say the company issues a bond on August 31st. Well, let's say the bonds pay interest on February 28th and December 31st. Okay, well, what do? Well, if you issue this bond on August 31st, okay, just like we saw in the prior example where on December 31st we recorded interest payable, we didn't have to do partial year interest for that because the interest payment date was January 1st. So it was for the full amount of the interest. But here, if we issue this bond on August 31st and our interest payment isn't until February 28th, well, on December 31st, we have to accrue for the amount of interest that was incurred. So basically, we do the same equations depending on, here this problem assumed we're using effective interest. So we would calculate interest expense by taking the carrying value times the market rate of interest. But now we have to multiply that amount by 4 over 12 because we only have 4 months in between August 31st and December 31st. We do the same thing with, here it would be interest payable instead of cash paid because we're not paying the cash till the end of February. So we take that maturity value of $100,000 times the 8% stated rate times 4 over 12 for the amount of months that are outstanding. Okay, just like you've seen in the past. Okay, so that's everything that we do in a bond while we are holding the bond during the term of the bond. What happens if the company wants to retire bonds before maturity? So we looked at these bonds. These were 5-year bonds. What happens in, say, year 2 if the company wants to retire the bonds? Why might a company want to retire bonds early? Well, we saw in these cash flows that the company has to make these interest payments each interest payment date. What if they don't want to have to make these payments anymore? Okay, so paying off their bond early can relieve these high interest payments. Maybe the company came into some cash. They want to pay off this amount so they don't have to make those interest payments. Maybe now they can borrow at a lower interest rate than they did when they sold the bond. So let's say in this bond case where they're paying $4,500 each interest period, that's bonds at 9%. Let's say now the prevailing market rate of interest is only 5%. So they could go out and borrow new money at only 5%. So maybe they want to pay back these bonds so they don't have to make those higher interest payments. That being said, what's going to happen if the prevailing market rate is 5% and these bonds pay 9% interest? They're going to have to pay a premium for that bond in the market, right? Because this bond pays higher interest. Okay, some bonds have a callable feature. Okay, a callable bond means the issuer can pay off the bonds at a prearranged price. Okay, that means maybe the company issued this bond and said, you know, after 2 years, we can buy the bond at 101. Okay, then let's say that market rate dropped to 5%. That might be better for the company to pay $101,000 for this bond and, you know, kind of save that interest between the 5 and the 9%. Whenever a company retires a bond before maturity, okay, if they retire it at an amount less than or more than the carrying value, they're going to record a gain or a loss. So how do we determine the gain or a loss on the early retirement of debt? Well, you compare the carrying value of the bond to the price paid for retirement. So you take the carrying value of the bond, that's the outstanding liability on the company's books, subtract off the price paid for retirement. If it's positive, there's a gain on retirement, because what does that mean? Okay, they're taking something off their books that, let's say, has a carrying value, let's say $102,000. Okay, then they retire it, they pay $100,000 for this bond. So they're taking a liability off their books of $102,000. They're only paying $100,000 cash. So that would be a $2,000 gain on retirement. If negative, there's a loss on retirement. So if the carrying value is that $102,000, but now they have to pay $105,000 to retire the bond. Okay, they take $102,000 liability off their books, but in exchange they pay $105,000 for it. Okay, they're going to have a $3,000 loss. Okay, gains and losses in early retirement of debt, okay, are reported as other income or loss on the income statement. Okay, let's go through an example. This is an old exam question. On March 31st, 2009, Bundy Corporation retires $10 million of bonds, which have an unamortized discount of $500,000 by repurchasing them in the market for $9,850,000. Calculate the gain or loss on the retirement of the bonds. Remember, the gain or loss equals the carrying value minus the price paid for retirement. So here we first have to calculate what the carrying value is. So this bond is a discount. It was has a $500,000 unamortized discount. So the carrying value is that maturity value of $10 million minus the unamortized discount, which the problem tells you is $500,000. So the carrying value here is $9,500,000. Okay, so our gain or loss, so $9,500,000. Hey, we pay $9,850,000. So when we calculate this, we get a negative $350,000. So that means it's a $350,000 loss. Why is it a loss? Because We're retiring bonds that have an outstanding liability of $9,500,000. So we're taking a $9,500,000 liability off our books, and in exchange we have to pay $9,850,000 for it. Okay, so $350,000 loss. A company can also issue what are referred to as convertible bonds. A convertible bond allows the bondholder to exchange their bonds for stock. Why would an investor want to buy a convertible bond? Well, again, kind of consider back what are kind of the risks and rewards of buying stocks over buying bonds. Okay, when a bondholder purchases a bond, they get a set interest rate. They're entitled to that interest before anybody else gets anything. That interest is an expense of the company. Okay, so they kind of stand in line before the stockholders because that interest is an expense. However, what happens in the case of stock? In the case of stock, if the company is doing good, the company might issue either a dividend, or if the company's doing well, the stock price might increase, and therefore the investor could sell their stock and get capital gains from the increase in the stock value. So kind of bonds are less risky than stock, okay, because the interest payment they get first. So when the company is doing poorly, okay, it's better to invest in bonds because you're entitled to that interest payment. You're a creditor. You stand in line first if there's any bankruptcy, if the company's liquidated. But in good times, what happens? You still only get that set amount of interest. You don't get anything more. Whereas in the case of stock, okay, the better a company's doing, kind of the more rewards. So convertible bonds kind of sit in the middle here. Okay, you kind of get your cake and eat it too. Right? If the company's doing bad, you keep your bond, you're entitled to those interest payments. If the company seems to be doing well, you could convert those bonds into stock and get the rewards of having either those dividends or the increase in stock value. Okay, so, but why would a company then issue convertible bonds? What is the benefit to the company? Well, yes, when the bonds convert, stock goes up, bonds go down, so their liabilities go down. But because this bond has this feature, generally the company can issue these bonds at a lower interest rate, okay, because it has this extra feature for it. So what happens? What happens when you actually convert these bonds? Basically what happens is you just take the bonds off the books, put the stock on the books. Alright, so let's look at what journal entry the company would record for convertible bonds. Let's say we have bonds that are issued at a discount. So there's an outstanding discount on the bond. Well, you have to take the bond off the books. So you're going to debit your bonds payable. Again, that would be for the maturity value because that's what your bonds payable is on the books for. If this is a discount, we would have to credit discount on bonds payable for the unamortized amount. Again, we would have to credit it because when we first issued this bond, we debited discount. So now we are taking it off the books because this bond is no longer going to be on the books. So we have to credit discount on bonds payable. Okay, so that's the part of the entry where we take the bonds off the books. Now we have to put the stock on the books. So we put the stock on the books by crediting common stock. This would be for the par value. Generally, your convertible bond is going to say each bond is converted into X number of shares of stock. So this would be the par value per share times the number of shares. And then you have your additional paid in capital. This would be your plug number, whatever it needs to be to make debits and credits equal. Let's look at a problem. Coastal View Imaging Limited issued $3,300,000 as 6% notes payable on December 31st, 2010 at a price of $95. The notes term to maturity is 20 years. After 4 years, the notes may be converted into Coastal View common stock. Each $1,000 face amount of notes is convertible into 50 shares of $1 par value common stock. On December 31st, 2015, note holders exercise their right to convert all the notes into common stock. Without making journal entries, compute the carrying amount of the notes payable at December 31st, 2015, immediately before the conversion. Okay, the company uses the straight line method to amortize bonds and notes. First, don't let this problem confuse you that this says it's a notes payable. Okay, remember, notes and bonds can work in exactly the same way. So if it confuses you, just change notes to bonds and answer it that way. Okay, so 1, we need to figure out what the carrying value of the bond is, or in other words, we just have to figure out what the amount of discount remains on this so we can record that journal entry. Okay, so what is the issue price? Well, the problem tells us we issued these notes at 95. Okay, maturity values $3,300,000. We issued at 95, so that means 95% of the maturity value. So you multiply by 95%, get $3,135,000. Okay, this is our issue price, our total discount. Maturity value minus the issue price. Get total discount of $165,000. Luckily, we look at the problem, and the problem says we're using the straight line method. Why are we lucky that we're using the straight line method? Because so you don't have to calculate it each year for the 5 years. You can calculate how much of the discount is amortized in each period, and it's the same each period. So here, this is 20-year note. So we take the total discount, $165,000, divide by 20 to see how much of the discount is amortized each period. We get $8,250. At the time that we're converting these notes, 5 years have gone by. So we figure out how much of the discount is amortized after 5 years by multiplying that $8,250 by 5. Get $41,250. So what is the remaining discount? All right, well, we started with $165,000. This company will have amortized $41,250. So the remaining or unamortized discount is $123,750. Okay, so the carrying value when these are converted, maturity value of $3,300,000 minus the unamortized discount of $123,750. Means our carrying value equals $3,176,250. Number 2, journalize the conversion transaction at December 31st, 2015. First, how many shares are issued? Well, if we look in the problem, it says each $1,000 face amounts of notes is converted into 50 shares of $1 par common stock. Okay, so the face value of these notes is $3,300,000. Divide that by 1,000 to see how many $1,000 issues we have. Each $1,000 issue gets 50 shares of stock. Multiply by 50 means we're issuing 165,000 shares. Okay, total coincidence that this 165,000 is the same amount as the original discount. So now we make our conversion entry. So we take the liability off the books. So we debit the notes payable. Again, if this was a bond, it'd be a bonds payable for that maturity value, $3,300,000. Okay, we credit the discount for the amount of unamortized discount that remains on our books. And that's the amount that we computed over there, the $123,750. We credit common stock for the par value. So problem told us this was a $1 par value common stock, so $1 per share. We're issuing 165,000 shares. So we credit common stock for 165,000. And then our plug number, everything else goes into additional paid-in capital. So that's $3,011,250. Any questions? Okay, for review. Okay, under the effective interest amortization, the two amounts calculated are interest expense and cash paid for interest. Okay, that means your discount or premium amortization each period is your plug number. Okay, interest expense equals carrying value of the bond times the market rate of interest. Cash paid for interest, that's the interest payment, is your maturity value times the stated rate of interest. Okay, under straight line amortization, the two amounts calculated are the discount or premium amortization and cash paid for interest. Interest expense is your plug number. So your discount or premium amortization is your total discount or premium divided by the number of interest periods. Cash paid for interest, same calculation, maturity value times the stated rate of interest. Okay, you use these along with those interest entries. So for a discount, you're going to debit interest expense, credit discount on bonds payable, credit cash. In the case of a premium, you debit interest expense, debit premium on bonds payable, credit cash. calculating your carrying value of your bond payable in the case of a discount is your maturity value minus any unamortized discount. In the case of a premium, it's your maturity value plus any unamortized premium. And if you have an early redemption of your bond, okay, you're going to calculate the gain or loss on retirement by taking the carrying value of the bond and subtract the price paid at retirement. This is a positive number, it's a gain. Negative number is a loss. Okay, some problems. If a bond payable is issued at a discount, the amount of the carrying value, again the long-term liability reported on the subsequent balance sheets, does it remain constant, increases each year, decreases each year, changes from year to year depending on the market rate of interest, or changes from year to year depending upon the stated rate of interest each year? B, increases each year. Okay, remember, carrying value is the maturity value minus any unamortized discount. Okay, in the subsequent years, you're going to amortize your discount, which means your unamortized discount becomes less. So the amount that you subtract off from the maturity value gets less, so your carrying value increases. Okay, which of the following statements is true regarding a bond issued at a premium? A, interest expense is greater than the cash interest payment, less than the cash interest payment, or equal to the cash interest payment. B, interest expense is less than the cash interest payment. Okay, remember what our interest entry looks like in the case of a premium. We debit interest expense, debit premium on bonds payable, credit cash. If you ever forget how that entry is structured, what can you think of? What can you use to help you remember it? Well, you can think back to what is the entry that I recorded when the bond was issued at a premium. Because that one's easy to figure out, right? Okay, if the bond is issued at a premium, you debit cash for the amount that you receive. And you always credit bonds payable for that maturity value. So you can make up numbers if it helps you. So let's say this was that $100,000 bond, a premium, cash $104,000. Got an extra zero. 100. So we know we need credit. So we know when we initially recorded that bond, we recorded a credit to premium. Okay, then we know each interest payment, we have to amortize that premium to get rid of it. So we just do the opposite of what we did in the entry when we first recorded it. So when we first recorded it, we recorded a credit to the premium, so we know we need to debit it in the interest payment. Okay, and I say that because sometimes in the interest payment, it's harder to kind of visualize, but everybody kind of understands how that bond issue entry works. So if you ever get to an exam and you're confused, remember that bond issue entry, and then you can figure out the interest entry. So here, if we're looking at this, the amortization of that premium makes the interest expense less than the cash. So the answer here is B. Okay, next question. And the next couple questions that you will see are very similar. I think these are actually old exam questions. So this will be how you will see this on your exam. Okay, on January 1, 2009, Jason Company issued $5 million of 10-year bonds at a 10% stated interest rate to be paid annually. If Jason issued the bonds for $5,325,000, how much would the premium amortization be on December 31st, 2009 under the straight line method, assuming the market rate of interest on date of issue was 9%? So two main things that you have to look at in any of these problems. One, you have to look at what is the question asking for. So here, the question is asking for premium amortization. And two, what method is the problem using? Here, straight line method. So once you know what the method you're using, you think about what does this method directly compute? Straight line amortization directly computes the amount of discount or premium amortization and the amount of cash paid for interest. Okay, here the question's asking for premium amortization, so it's one of those direct calculations. So here, these are $5 million bonds that we're issuing for $5,325,000. So what is our total premium? Issue price of $5,325,000 minus the maturity value of $5 million. So total premium $325,000. Okay, once you figure out the premium, you need to figure out how many interest periods there are so we can figure out how much is amortized each period. So these are 10-year bonds where interest is paid annually. Okay, so 10-year bonds, one interest period per year. So there's 10 interest periods. So we simply take this $325,000 and divide by 10. We get $32,500. Next problem. Okay, we're using the same information in this problem, and I use this just to kind of show you all the different questions that can be asked with the same information. So the only difference here is that this question is asking for the amount of interest expense that they should report on December 31st, 2009. Okay, we're still using straight line. Okay, so we just calculated the amount of premium that is amortized each period. What is our interest payment? Remember, under straight line, we calculate the premium amortization and we calculate the interest payment. This is our maturity value times the stated rate. So maturity value, $5 million. Look in the problem, these 10% bonds. Interest is paid annually, so it's 10% per period. So the interest payment, $500,000. Okay, then we look at our entry. We debit interest expense. Debit premium on bonds payable, credit cash. Cash is $500,000. The premium amortization we calculated over there, $32,500. So interest expense is our plug number. So the $500,000 minus the $32,500, we get $467,500. So the answer there is E. Yes. The question was, would a problem ever be set up where it wasn't December 31st Could be. Well, it could be that your interest payment date was a date other than December 31st, and it asks you something about the entries that would be recorded at December 31st or at year end. And then you just use that partial year where you take the amounts calculated under your normal equations and multiply by the number of months outstanding over 12. Good question. Any other questions? Okay, next question. On January 1, 2009, Allison Company issued 600,000 5-year 8% bonds at $570,000. The bonds were dated January 1, 2009, and interest is payable each June 30th and December 31st. The company uses the straight line method of amortization. The amount of the book or carrying value for the bonds payable that would be reported on December 31st, 2009 balance sheet is. Okay, here, what's going on here? Well, one is asking for the carrying value of the bonds on December 31st, 2009. Okay, these are bonds issued at a discount, so we know the carrying value equals the maturity value minus the unamortized discount. Okay, so we need to figure out in this, we're trying to figure out what is the amount of the discount that we've amortized, so we can figure out what the total unamortized discount is. Okay, we're using straight line method, so we're going to directly compute the amount of discount that is amortized. What else do we need to see in this problem and be careful with? It's semi-annual interest. There's 2 interest payments per year. Okay, and this question is asking for what is the carrying value on December 31st, 2009. This is after the second interest payment. Okay, so what is the discount? So our total discount, these are $600,000 bonds that were issued at $570,000. So our total discount, $30,000. So straight line, we take this total discount and divide by the number of interest payments. So these are 5-year bonds, okay, but interest is paid semi-annually. So there's 10 interest periods, 2 per year, 5 years, so 10 total interest periods. So $3,000 is amortized each interest period. Means $3,000 was amortized on June 30th. $3,000 was amortized on December 31st. So the amount that's amortized is $6,000. So for calculating our carrying value, maturity value $600,000 minus our unamortized discount. Start with a discount of $30,000. We amortize $6,000 over those 2 interest periods, which means we have $24,000 remaining. So our carrying value is at $600,000 minus the $24,000, or $576,000. Any questions? Okay, next question. On January 1, 2009, Dorley Corporation issued $1 million of bonds for $1,073,613 when the market rate of interest was 6%. They are 10-year bonds paying 8% interest annually. Dorley Corporation is using the effective interest amortization method. Interest expense on December 31st, 2009 would be. Okay, so again, we're looking at what method? Effective interest method. Effective interest, we directly compute interest expense and cash paid for interest. This question is asking for interest expense. Okay, the other thing that you want to be careful about is when is it asking you to calculate interest expense. Here it's asking for on December 31st, 2009. These bonds pay interest annually, which means what interest payment is December 31st, 2009? The first one, right? It's just asking for interest expense for the first interest payment. And under the effective interest method, we directly compute interest expense. So it's a pretty easy question, right? So our interest expense equals our carrying value times the market rate of interest. I think something else that, sometimes I see here this problem does say the stated rate. If you're looking at a problem that's using effective interest method and they tell you maybe how much cash is paid for interest each period, you might not need to know what the stated rate is. Or here, if they're asking for interest expense in period 1, the question might leave out what the stated rate of interest was because you don't need that for the calculation. Okay, so the carrying value on the first interest period is just the issue price because we haven't amortized any of that premium yet. So $1,073,613. Okay, multiplied by the market rate of interest. Okay, interest is annual. Market rate is 6% per year. So multiply by 6%. We get interest expense of $64,417. Okay, that's the answer. It will tell you that on the semester that this question was on an exam. A lot of people got it wrong simply because they were trying to make too much of the question. Because they said that couldn't be all you had to do. You had to do more. Okay, so just read the question and answer what the question is asking you to answer. What happens if this question was changed? If all the information was the same, but what happens if it asks you to calculate interest expense on December 31st, 2010? Well, if it asked you for December 31st, 2010, you'd have to go through all your calculations for 2009 in order to calculate how much of the premium is amortized to calculate what your carrying value is for your interest payment for 2010. Okay, so let's go through. So you calculated interest expense for 2009. And then we're going to calculate cash paid for interest. Again, that's your maturity value. Multiply by the stated rate. So 1 million multiplied by 8% stated rate. We get cash paid $80,000. Figure this into our entries. So in a premium, we debit our interest expense for that $64,417. Debit our premium on bonds payable, which we're going to calculate. That's our plug number. Credit our cash, which is $80,000. Okay, we get our premium on bonds payable then is $15,583. Okay, we use that in order to now calculate what our carrying value is. Our carrying value is our maturity value plus our unamortized premium. We started off with a premium of $73,613. Again, that comes from the issue price was $1,073,613. So $73,613 above the $1 million maturity value. And we're going to subtract off the amount that we amortize in the first interest period, the $15,583. So our unamortized premium, $58,030. Add that to our maturity value of $1 million. Carrying value is $1,058,030. So now our interest expense in the second period is that carrying value of $1,058,030 multiplied by the market rate of interest, which is 6%. So our interest expense is $63,482. Any questions? Okay, the next thing that we're going to look at is understanding the advantages and disadvantages of borrowing. So we went through in this chapter two major ways to borrow money. Okay, raise capital. Either you go out and you issue notes, okay, go sign a promissory note for a bank, okay, or you go issue bonds. Well, there's three kind of total ways to finance a company, raise capital. Okay, one way is just for the company to use its own money. That's using retained earnings to finance operations. Because what is retained earnings? Retained earnings is all the earnings of the company that the company has retained in their business and not distributed out to stockholders. The advantage of using retained earnings to finance operations is that the money is there. The money is the company's. The company doesn't have to pay to borrow the money. Okay, the disadvantage is the company's limited by the amount that they can use. They're limited to the amount that they have retained in the business. Okay, if you don't have enough money in retained earnings to finance operations, the other two choices are issuing stock or issuing bonds. Okay, each one has advantages and disadvantages. For issuing bonds, the disadvantage is you have to make these interest payments. These interest payments are an expense. On the other hand, interest expense can kind of be seen as an advantage in the sense that interest expense is an expense. Okay, what does an expense do? An expense decreases your income, which in turn decreases the amount of tax that you pay. If you issue stock, you don't have these interest payments that you have to make. Okay, but what happens? You're kind of diluting the company the more stock that you issue. Okay, one common metric for a company that investors look at to determine how a company is doing is earnings per share. This is earnings per share is something that all companies report on their income statement. It's one thing that you can compare between all companies of various sizes. Okay, we're going to look at here the effect of earnings per share if you decided to borrow money or if you issued stock. So let's say a company needed $500,000 of capital to do a special project and expand. Okay, well, their two plans are either they borrow $500,000 at 6% or they issue $500,000 of stock. So let's look at how this would affect their financial statements. So first, they borrow $500,000. Okay, so net income before the expansion, $300,000. This is the same under both scenarios. Okay, under both scenarios, we project that the expected income before interest and taxes on this project is $200,000. Okay, now we're in the case of we're borrowing funds. Well, if we're borrowing funds at 6%, we have to pay interest. So 6% of $500,000, okay, $30,000. So that's going to be interest expense. That's going to decrease the amount of income that we earn, okay, which means our income taxes are $68,000. Okay, this means our expected project net income after we subtract off interest expense and income taxes is $102,000. Okay, this gives us total net income of $402,000. We have 100,000 of common shares, which gives us earnings per share of $4.02. Instead of borrowing the $500,000, we could issue $500,000 worth of stock. Let's say we issue 50,000 additional shares of stock and that gives us the $500,000 that we need. So we still have net income before expansion of $300,000. Our expected project income is the same because nothing has changed with the project, right? It's just how we generated that $500,000. Under this plan where we issued the stock, we don't have any interest expense because we didn't borrow the money. So now our income taxes are $80,000 because we didn't have that $30,000 reduction. So our projected project net income is $120,000, a little bit higher. So now total net income $420,000. But now look what happens. Okay, now we have 150,000 shares outstanding because we issued 50,000 more shares. Earnings per share is your net income divided by the common shares outstanding. So now our earnings per share is only $2.80. So these are the things that the company has to kind of look at to determine whether they're going to borrow the money or whether they're going to issue their stock. Any questions? One thing that some people look at is the ratio called the times interest earned ratio. Basically, this ratio tells us, is the company comfortable in being able to pay their interest expense when it becomes due? Okay, times interest earned is the operating income divided by interest expense. Basically tells you how many times operating income is of the interest expense. Okay, what is operating income? Well, another way you can think of operating income is the company's net income plus interest expense plus income tax expense. So it's the income before interest and income taxes. Okay, high ratio means you have your operating income is large compared to the amount of interest expense, and you're going to have ease in paying your interest. Low ratio, you're going to have difficulty in paying your interest. Any question on times interest earned ratio? Okay, the last major thing we're going to talk about in this chapter are leases. There's two different types of leases that a company can do, either an operating lease or a capital lease. The accounting treatment for these different leases are very different. An operating lease is what you normally think of as a lease. Okay, under an operating lease, the lessee, that's the person who's leasing the item, has the right to use the asset. The lessor, that's who you normally think of as the landlord, retains the risks and rewards of owning it. Okay, the lessee here records rent expense for the amount that they pay for the rent or to lease the item. So here, let's say the company's leasing a piece of equipment. Okay, the lease provides that the company has the right to use this equipment during the term of the lease. Okay, the lessor, the person leasing that equipment to you, still owns the equipment, still has all the risks and rewards of owning. And at the end of the lease term, they're going to get that piece of equipment back. Okay, so this is just like you think of leases. Okay, the company will record rent expense, okay, when they incur that rent. A capital lease, on the other hand, under a capital lease, the lessee has the right to use the asset, just like under an operating lease. However, the lessee is the one that assumes the risks and rewards of ownership. And we'll get into in a minute how we determine that the lessee assumes risks and rewards of ownership. Okay, under a capital lease, the lessee capitalizes the lease asset and records a long-term liability. Basically, a capital lease is just like, you can think of it more as the company's purchasing an asset and paying for it over time. We say, since this lessee assumes all the risks and rewards of ownership, really what's happening here is not so much a lease transaction, but instead the lessee, the person using that asset, is basically purchasing that asset from the lessor and just paying for it over time, paying in installments. It more closely resembles a purchase transaction, paying in installments, instead of a lease transaction. Okay, under a capital lease, you would record the asset. So you debit equipment on your books, and then you'd credit this lease liability. Okay, just like what happens if you purchase that piece of equipment and signed a note. You would debit equipment, credit the notes payable, right? Same idea here. You debit the equipment, credit lease liability. The lease liability is going to be a liability on your balance sheet, just like that notes payable was. Okay, so how do you determine if something is a capital lease? Okay, well, FASB statement number 13 tells us if a lease contains any one of these items, it's a capital lease. Okay, keep in mind it's any one of these items. So meeting one of these things will mean you have a capital lease. So 1, transfer of title at the end of the lease. So what does that mean? You lease a piece of equipment. Say you lease for 5 years, you're paying lease payments for 5 years, then at the end of 5 years, that piece of equipment becomes yours. Okay, the title of that piece of equipment transfers to the lessee at the end of the lease term. So really, again, what has happened there? Well, again, that really looks like you're purchasing the asset, paying for it over 5 years, and then you get title to that asset at the end of 5 years. Okay, the next criteria is a bargain purchase option. So if the lease contains a bargain purchase option, so again, let's say you lease that piece of equipment, you're leasing it for 5 years, and the lease provides that at the end of the lease term, you can purchase that asset for $1. Well, really, isn't that the same thing as the situation we just talked about? You can see why these things come into play. People trying to get around what happens, right? That's why as a course, the longer that you do this, your syllabus keeps getting longer because things happen and you add things in. Same thing happens with the FASB, right? Okay, so they probably said, well, transfer of title at the end of lease means this is in essence a purchase with installment payment, so that's a capital lease. So what did the lessees and the lessor say? Well, title isn't automatically going to pass at the end of the 5 years. Instead, you have to purchase this asset for $1. Well, that's not the fair market value of the asset at the end of the lease term. So therefore, in essence, those two things are the same. So as long as the lease contains a bargain purchase option, and a bargain purchase option just gives the lessee the ability to purchase that asset for an amount lower than fair market value at the end of the lease term, that would be a bargain purchase option. Okay, another criteria, the lease term is greater than 75% of the useful life. What we're saying here is, let's say we have a piece of equipment that, let's say, can be used for 6 years. Realistically, this piece of equipment is going to last for 6 years. Well, if you lease this for 5 years, you're using it for the majority of the useful life. Okay, or let's say it's 10-year useful life, you use it for 9 years. Okay, you're using it for the majority of the useful life, and therefore it's like you're purchasing it. So this is a capital lease. And the last criteria is the present value of the lease payments are greater than 90% of the fair value of the asset. Okay, remember what's happening here. You're paying for it in these lease payments over time. Okay, what is that worth today? You figure out what the present value of those lease payments are. If it's greater than 90% of the fair market value on today's date, okay, essentially you should treat it as you're purchasing the asset and record the liability. Why would a company want to record something as an operating lease instead of a capital lease? So you see here that these capital lease criteria were developed basically so you're not treating something as a capital lease that really looks like the purchase with installment payments. Why would you want to treat something as an operating lease instead of a capital lease? Well, again, let's go through what you would record under an operating lease and a capital lease. Okay, so first, operating lease. What do you record under an operating lease? What do you record on day one? Nothing, right? Because under an operating lease, you record rent expense, you record cash. Okay, so to make it easy, let's say you incur the rent expense when you pay the cash. So when you make the rent payments, you would debit rent expense, credit cash. If the cash came first, again, you'd debit prepaid rent, credit cash, and then you'd record rent expense and decrease your prepaid rent. So this rent expense is just going to be the amount of expense that you record each year and the amount of your lease payment. What about a capital lease? Well, a capital lease, we say, is really essentially you're purchasing the asset and paying for it over time. So under a capital lease, let's say this is a piece of equipment. You put the asset, the equipment, on the books, and you'd credit the liability. So it's just instead of a notes payable, this would be a lease liability. What amount would this be for? Well, your lease liability would be for the present value of those lease payments. If you make any payments in cash at the beginning, that would be a credit to cash. So by avoiding this capital lease, you avoid putting that big liability on the books. You're only recording the expense as you incur it. So that's why a company might want to avoid this capital lease. Okay, so let's look at a problem. American Family Association acquired equipment under a capital lease that requires 6 annual lease payments of $40,000. The first payment is due when the lease begins on January 1, 2010. Future payments are due on January 1 of each year of the lease term. The interest rate in the lease is 16%. Okay, 1, record the acquisition of the equipment. Okay, so this lease requires 6 annual lease payments of $40,000. First payment is due when the lease begins on January 1, 2010. Future payments are due January 1 of each year of the lease term. Interest rate 16%. So how do we record the equipment? What is the value of this equipment? It's the fair market value, but what is the fair market value here? How do we determine that? Well, we determine that by saying, it's just like when we looked back in Appendix C, and we said you acquired a piece of equipment by paying in installments, right? You pay $40,000 a year. But wait, there's one thing that you have to look at that's a little bit different than what we did back in Appendix C. In Appendix C, remember when we talked about those annuities, and we said there was 2 types of annuities. An ordinary annuity and an annuity due. Okay, we said an ordinary annuity, did that have payments at the beginning or the end of the period? The end of the period. We said everything that we do in this class are ordinary annuities. The present value tables that are in our books relate to an ordinary annuity where payments are at the end of the year. Annuity due was payments at the beginning of the year. So be very careful here. What's happening here? Okay, this is 6 payments. When are the payments? It says the first payment is due when the lease begins on January 1, 2010. So this is at time 0. So here are payments. Okay, payments are due at the beginning of the year. Okay, but I just said our charts in the back of our appendix are based on the end of the year. Okay, so what do we have to do? Well, this $40,000 payment is already in present value terms, right? Okay, we're paying that cash today. So we only have to figure out the present value of these payments. So to figure out how much this equipment is valued at, again, the equipment is valued at whatever the present value of these series of cash flows are. Okay, so under our equation, our present value equals our payment multiplied by the present value of an annuity factor. What is N? 5. N is 5 here because we're only looking at figuring out the present value of these 5 cash flows. Okay, this one, since payment is at the beginning, is already in present value terms. The problem tells us interest was 16%. So we look in the present value of annuity table, N equals 5, I equals 16. Get a factor of 3.274. Multiplied by 40,000. And we get a present value of 130,960. Okay, that's the present value of those future lease payments. Okay, so that's the amount of our lease liability that we record on our books. Okay, but if that's the amount of our lease liability, what do we debit our equipment account for? Well, what are we in essence paying for this equipment? We're paying $40,000 today plus these $40,000 payments. Okay, we figured out the present value of those 5 $40,000 payments that happen in the future is $130,960. Okay, so the value of our equipment is that present value plus the $40,000 present value that we pay today. So $170,960. So we debit equipment for $170,960, credit our lease liability for the present value of those future lease payments, so $130,960, and then we credit cash for that $40,000 that we pay today. Any questions? See some blank stares. So I think before we look at number 2 and 3, recording the journal entry for the first lease payment, the second lease payment, we'll call it a day. Go back, make sure you read the section on capital leases. We'll start off on class on Tuesday, starting with this problem again. Before you leave, okay, Tuesday's class, it looks like we don't have that much left to cover, and that was done on purpose. I wanted to try to get pretty much everything in Chapter 8 completed by today, so you had kind of the whole weekend to study this. Make sure you attempt the end of the chapter problems in Chapter 8. Then in Tuesday's class, we will finish these slides, so we'll go over this problem again. We'll do the end of chapter problems. Then I will open it up to any questions, because remember, next Tuesday's class is the day before the exam. So any questions, if you're watching the lecture online, you can email your questions by Monday and I'll bring them to class. After we answer any questions, then I will bring up the practice exam, and we will start going over the practice exam in class. Okay, at that point, if you haven't started the practice exam, either leave class or turn off the lecture. I want you only to kind of be going over the practice exam with me if you have already taken the practice exam. Any questions? Okay, have a good weekend.